So let's talk about the kinds of things that people should be doing between now and the end of the year and looking forward to 2013 to try to mitigate the effect of some of this. So when we talk about increases in income tax rates, what are the kind of things people should be thinking about doing in advance of the end of the year?
The best way to approach this is we don't know what's going to happen at the end of the year. These Bush tax cuts could get extended, there could be compromises, or they could just vanish and we could be subject to these higher tax rates. So the key really is to plan as if the tax rates are going to go up, but to put some kind of flexibility in our planning so we could sort of tee up what we might want to consider doing and then act on it when we have a better idea, maybe after the election, as to what the law is going to be. Like what some of the things you can look at. Let's say that you might have some kind of a transaction where you're considering selling a business. It's to the extent you have control over it and it makes economic sense, maybe you plan to try to trigger the tax this year. Maybe if you were going to sell a business and you were going to collect money over time and you could have elected installment sale treatment, maybe you put yourself in a position where you think about accelerating the gain into 2012 versus 2013, because as you said, if you take a look at the expiration of the Bush tax cuts plus the 3.8% additional Medicare tax on unearned income, capital gains could be taxed at 23.8%. It's more than a 50% increase as to the 15%. So it's a huge thing. So it may make sense to accelerate income into 2012 versus to wait till 2013 or dribble it out over years, because the rate differential is so much, and people really aren't getting that much on their money, in terms of time value of money of paying the taxes.
So let's talk about that for a sec. So if I close the transaction in the current year, and it's a capital gains transaction, you're looking at a 15% federal rate.
Correct.
If you close the transaction in 2013, at a minimum, you're looking at a 20% capital gains rate. And if it's a passive activity, it could be another 3.8%, so it could be 24%.
Yeah, exactly.
So the key is, can I close before the end of the year? Do I have the flexibility or optionality to get that done, number one? What is the cost to me of getting the transaction done this year versus next year? It sounds like it could be somewhere between 5 and 8.8%, versus having to pay the tax in April of 2013 versus paying the tax in April of 2014 if I close in 2013.
Or even longer if you collected money over it.
Or maybe even longer. And it seems to me that given where interest rates are, it's going to be hard in a lot of circumstances to justify that closing later at higher rates makes more sense, notwithstanding the time value issue.
Yeah, agreed.